How can you explain that a dividend company's stock falls by about 75% in the last year, 64% down since January of this year, and it went down to the point that the expected dividend yield is about 19%, while in 2022 they had an increase in revenue, net income, gross margins, free cash flow, dividends, and for EBITDA lovers they also had an increase in EBITDA and almost no change in outstanding shares. So it kinda doesn't make any sense that a company in 2022 doing better than 2021, but its stock continues to be in a free fall. Therefore, I think the market is very sensitive to a weak item in the financials of VIA Renewables, and we will go over it in a minute. But before we do that, let me remind you that this video is not financial advice and is for entertainment purposes only. This company, VIA Renewables, is a utility company and specifically a retailer utility company. They buy gas and electricity from wholesalers or producers and then use their channels to distribute them to the consumers. They operate in 102 utility territories in 19 states in the United States of America. VIA Renewables has one equity security, ticker symbol VIA, and they report their operations in a fiscal year that ends on December 31st. This company is a microcap company. This means its market cap using today's stock price is between $50 to $300 million, and specifically, its market cap is $69 million. Most of the 2022 revenue was made from retail electricity, and about a quarter of the revenue was generated from the sale of gas. Checking the revenue growth year over year, this company was $1 billion in revenue in 2018, but since then it's losing the market share. Until 2022, they actually had 17% increase in revenue from 2021. Checking the debt to asset ratio, in 2022 it's 36%, which is in the okay area, but I wish it was a little bit lower. Now we can address the weakness in the financials that is scaring away the market from this investment. In my opinion, the market is concerned about this company's ability to service the debt, because in 2022, they only made 6 times the interest expense that they had to pay in 2022. The minimum accepted ratio is 7. The good news I have about this issue is that it seems that the Fed will not increase the interest rate for the rest of this year. Of course, we don't know that for sure, but that's what I think. So it could be a sigh of relief for this company, because that means if they don't get more debt, the interest expense will not increase because of the increase of the interest rate. Checking the outstanding shares, it doesn't seem that there is a meaningful increase in the past few years. As I mentioned in the beginning of this video, this company is a dividend company, and in 2022 they distributed $3.63 per share. Using today's price, the yield is about 38%. And the first quarter of 2023, they distributed 91 cents per share. In my opinion, they will not distribute another high dividend this year and will only distribute $1.81, which makes the expected dividend yield 19%. I think this company should not distribute any more dividends and focus on reducing the debt. They have $120 million in debt, and in 2021 they distributed $33.6 million in dividend. In my opinion, if that $33.6 million went to reduce the debt, then the share price will gradually pick up, because it will be easier for them to service the debt, so in other words, the times interest earned ratio will increase. Moving to the forecast part, one could argue that the assets of this company is what drives the revenue, but when reading the annual report, it is mentioned many times that the number of customers is the crucial factor that drives the revenue. Therefore, I will use that for forecasting next year's revenue. The company started 2023 with 331,000 customers, but in the 2023 Q1 report, they mentioned that they acquired 47,000 more customers. Also, I used the average revenue per customer for the past 2 years only because it would reflect the increase in crude oil prices. That would give us revenue of about $421 million for 2023. The free cash flow to revenue ratio is 3% for the past 2 years, so I will use the same ratio even though it's about 9% in the first quarter of 2023. But in my opinion, we should be conservative in the forecast. We're using the outstanding shares in the first quarter of 2023. And for the discount rate, we're using the treasury bill interest rate. And for the return on investment ratio, we're using the 19% that's the expected dividend yield in 2023. These 5 forecast keys, in my opinion, will give us an intrinsic value of $5.82 per share, which makes the share price overvalued by about 62%. But I'm optimistic because in the 2023 Q1 report, it shows an increase in revenue and free cash flow, which is a very good start for 2023. I understand that the net income is negative for that quarter, but I don't think it's the right way to measure a company's activity because there are many non-cash transactions in the income statement. Personally, I will definitely buy this stock and hold it until at least I double my investment, and meanwhile collect some dividends. Thank you for joining me in this analysis. Have a great day and more dividends.